In our latest weekly update, we explore how the RBA is caught between stronger global economic indicators and weaker local conditions, and what this means for local households, the property market, and banks. Welcome to the Property Imperative Weekly to the 11th of November 2017. Hi, I'm Martin North, Principal Analyst at Digital Finance Analytics. We start this week's digest with the latest results from the banking sector. CBA's first quarter 18 trading update reported a rise in profit and volumes, as well as a lift in capital. Expenses were higher, reflecting some provisions relating to AUSTRAC, but loan impairments were lower. WA appears to be the most problematic state. Their unaudited statutory net profit was around 2.8 billion in the quarter, and their cash earnings were 2.65 billion in the quarter, both up 6%. Both operating income and expenses were up 4%. Westpac's financial year 17 results were a bit lower than expected, impacted by lower fees and commissions, pressure on margins, the bank levy, and a one-off drop to compensate certain customers. Despite a strong migration to digital, driving 59 fewer branches and a net reduction of 500 staff, expenses were higher than expected. There's been a 23% reduction in branch transactions over the past 2 years in the consumer bank. Once again, this highlights the quiet revolution underway and the resulting problem of stranded costs. Treasury had a weak second half, but the key point to me is that around 70% of the bank's loan book was in one way or another linked to the property sector. So future performance will be determined by how the property market performs. Provisions were lower this cycle and at lower levels than recent ANZ and NAB results. Western Australian mortgage loans have the highest mortgage arrears, but these were down a bit. Looking at the mortgage defaults across the reporting season, there were some significant variations. Some, like Westpac, indicated that Western Australian defaults in particular are easing off now, whilst others like ANZ and Genworth still showing ongoing rises. This may reflect different reporting periods, or it may highlight differences in underwriting standards. Our modelling suggests that the rate of growth in stress in Western Australia is indeed slowing, but it is rising in contrast in New South Wales. See the 9TV News segment on which our research was featured, and also in Victoria. And there is an 18 to 24 month lag between mortgage stress and mortgage defaults. So, in the light of expected flat income growth, continued growth in mortgage lending currently running at 3 times income, rising costs of living, and the risks of international funding rates rising too, we think it's too soon to declare defaults have peaked. One final point, many households have sufficient capital buffers to repay the bank, thanks to ongoing home price rises. Should prices start to fall, then this would change the picture significantly. Overall, banks have enjoyed strong balance sheet growth in recent years, as they have lent more than ever for mortgages at the expense of productive business lending. A number of factors have driven the housing boom, and these include population and income growth, certainly over the past 25 years, a huge fall in interest rates, and increases in the tax advantages to property investment through first negative gearing, and also the halving of capital gains tax. Fitch Ratings says the banks had solid results in the 2017 financial year, supported by robust net interest margins and strong asset quality. However, they say, Australia's 4 major banks will face earnings pressure from higher impairment charges and lower revenue growth in their 2018 financial year, and cost control will remain an important focus. They benefited from the APRA-inspired repricing of mortgages and from lower impairment charges. Fitch says that mortgage arrears have increased modestly from low bases in most markets. Western Australia has been the most noticeable in terms of deterioration, and they expect this trend to continue in financial year 18, due in part to continued low wage growth and an increase in interest rates for some types of mortgages. The latest household finance data from the ABS confirms what we already knew. Lending momentum is on the slide, and first-time buyers, after last month's peak, appear to have cooled. With investors already twitchy and foreign investors on the slide, the level of buyer support seems anemic. Expect lots of special refinance rates from lenders as they attempt to sustain the last gasp of life in the market. The number of new loans to first-time buyers was down 6.3%, or around 630 on last month. We also see a fall in fixed-rate loans, down 14%, and the DFA-sourced investor first-time buyers also fell again, down 4%. More broadly, the flow of new loans was down $19 million, or 0.06%, to $33.1 billion. Within that, investment lending flows in trend terms fell 0.52%, or $62.2 million, to $12.1 billion, while owner-occupied loans rose 0.32%, or $47.4 million, to $15 billion. So investment flows still stand at 44.6% of all flows, excluding refinances. Refinance comprised 17.9% of all flows, down 0.07%, or $3.9 million, to $5.9 billion. Auction volumes were also lower this past week, partly because of the Melbourne Cup festivities, and CoreLogic's latest data suggests a slowing trend, more homes listed, and further home price falls in Greater Sydney. As a result, we expect home lending to trend lower ahead. The MFAA says that there's been a boom in mortgage brokers, but this may be unsustainable given lower mortgage growth. The snapshot they published up to March 2017 shows that the number of brokers was estimated to be 16,009, representing one broker for every 1,500 in the population, and they originated around 53% of new loans. Overall, the number of brokers rose 3.3%, but net lending grew only 0.1%. As a result, the average broker saw a fall in their gross annual income. Also on these numbers, brokers cost the industry around $2 billion each year. We published data on the dynamic loan-to-income data, LTI, from our household surveys. Currently, we estimate that more than 20% of owner-occupied mortgage loans on book have a dynamic loan-to-income ratio of more than 4 times income. Some LTIs are above 10 times income, and although this is a relatively small number, they are at significantly higher risk. Looking at the data by state, we see that by far the highest count of high loan-to-income loans resides in New South Wales, mainly in Greater Sydney, then Victoria and Western Australia. Younger households have a relatively larger distribution of high loan-to-income loans. Reading across our core segmentation, we see that young affluent households, exclusive professionals, and multicultural established households are the 3 groups more likely to have a high dynamic loan-to-income ratio. We also see a number of young growing families in the upper bands too. As many lenders also hold the transaction account for their mortgage borrowers, it is perfectly feasible to build an algorithm which calculates estimated income dynamically from their transaction history, and use this to estimate a dynamic loan-to-income ratio. This would give greater insight into the real portfolio risks compared with the blunt instrument of loan-to-value ratios. It is less misleading than LTI or LVR at origination. The latest edition of our Household Financial Security Confidence Index to the end of October shows households are feeling less secure about their finances than in September. The overall index fell from 97.5 to 96.9 and remains below the 100 neutral setting. We use data from our household surveys to calculate the index. While households holding property for owner occupation remain, on average, above the neutral setting, property investors continue to slip further into negative territory as higher mortgage rates bite, rental returns slide, and capital growth in some of the major markets stalls. Property inactive households remain the most insecure. So, owning property is still a net positive in terms of financial security. There are significant variations across the states. Victorian households continue to lead the way in terms of financial confidence, and Western Australian households are moving up from a low base. However, households in New South Wales see their confidence eroded as prices slide in some postcodes, and the average small fall as reported does not represent the true valuation on the ground. Some western suburbs have seen falls of between 5 and 10% in the past few months. Households in Queensland and South Australia are on average holding their position this month. Confidence continues to vary by age bands, although the average scores have drifted lower again. Younger households are consistently less confident compared with older households, who tend to have smaller mortgages relative to income and more equity in property and greater access to savings. As expected, the RBA held the cash rate again this week for the 15th month in a row. The RBA's statement on monetary policy highlighted the tension between stronger global growth, reflected in expected rising interest rate benchmarks in several countries, including the USA, and weaker inflation and growth in Australia. As a result, pressure to lift the cash rate here appears lower than before. Underlying inflation is expected to remain steady at around 1.75% until early 2019, before increasing to 2%. The revised CPI weightings, now announced by the ABS, will tend to reduce the inflation numbers in the next release. The RBA suggests growth will be lower for longer, though is still holding to a 3% growth rate over their forecast period. They also highlighted the impact of stagnant wage growth and high household debt once again. If rates do stay lower for longer, it may benefit households already suffering under mountains of mainly housing-related debt, but put pressure on the dollar and terms of trade. As rates overseas climb, sucking investment dollars away from Australia and lifting funding costs. Some are suggesting that the gap between income and credit growth, 2% compared with 6% over the past year, will in fact require the RBA to lift the cash rate sooner, and ANZ, for example, is still forecasting rate hikes in 2018. International conditions are on the improve, and many assume the rise in benchmark cash rates will be slow and steady. However, a guest post on the unofficial Bank of England's Bank Underground blog makes the really interesting point that by looking at data over the past 700 years, that most reversals after periods of interest rate declines are quite rapid. When rate cycles turn, real rates can relatively swiftly accelerate. The current cycle of rate decline is one of the longest in history, but if their analysis is right, the rate of correction to more normal levels may be quicker than people are expecting, and a slow rate of increase designed to allow the economy to acclimatise may not be possible. And that's not pretty if you are a sovereign or a household sitting on a pile of currently cheap debt. So we see on one side global conditions improving with interest rates set to rise, whilst locally economic indicators are weakening, suggesting the RBA may hold the cash rate lower for longer. This is creating significant tension and highlights the dilemma the regulators face. But as we said before, this is a problem of their own making, as they dropped the rates too far and did not recognise the growing risks in the housing sector soon enough. So, already on the back foot, we expect to see some further targeted regulatory intervention, and we expect the cash rate to stay lower for longer until the international upward pressure swamps the local situation. We think this may be much sooner than many who are now talking of no rate change for a couple of years may think. Meantime, households with large loans, little income growth, and facing rising costs will continue to spend less, tap into savings, and muddle through. Not a good recipe for future growth and economic success. As Laurel and Hardy used to say, well, here's another nice mess you've gotten me into. And that's the Property Imperative Weekly to the 11th of November 2017. If you found this useful, do leave a comment, subscribe to receive future updates, and check back next week. Thanks for watching.